Hi folks, and welcome back to Meaningful Money. Here I am. This is Long Rock Beach behind me. Over my left shoulder is the world famous St. Michael's Mount, obviously probably the local landmark. It's a pretty cold November afternoon, so just one here I think, and perhaps come back here another day and do some more. But for now I think I'm going to be a bit too chilly if I hang on too long. So we need to talk finally about inheritance tax planning. We've covered income tax planning, capital gains tax planning, so now we need to get on to inheritance tax, the last of the major personal taxes. I'm probably going to do this over two videos, but when it comes to inheritance tax planning, you've got three broad strategies. You can either spend all your money so that your estate is so small that there's no inheritance tax to pay, so spend it all. You can give all your money away, or you can take out some kind of insurance, life insurance, to pay for the inheritance tax liability after you've gone. So let's just cover those three things in just a little bit more detail, and I'm going to come back to number two, which is giving it away, next time, because there's quite a bit more detail there. So the first one is to spend all your money. Now this sounds like a great idea to me, and I'm convinced I spend at least half of my time, if not more, telling my clients to give their money away rather than to spend it rather than to save it and hoard it. Money is, after all, a tool for using, and so I make a point of telling my clients that and help them to enjoy their life as much as possible by spending their money. Problem is, it can be a bit of a generational thing. Many of my clients are retired, and so they're used to working hard and saving hard all their lives, and they knew hardship in the post-war years, so it's difficult to turn that around and get on with spending money and enjoying life when they've worked so hard to amass some money to enjoy. So spend all your money. I did hear it say that probably the perfect scenario is to spend your last pound on the night before you die. The problem with that is, obviously, we don't know when we're going to die, but the principle simply is that you don't want to die with too much money, because you could have achieved more, done more with your life. You don't want to run out of money. So if you can spend that last pound the day before you die, then that's perfect. However, we don't know when we're going to die, so it's difficult to plan for that. But I'm all for spending your money. Remember, it was just 3 or 4 videos ago, episode 67, at how inheritance tax works. It's on your estate in excess of $325,000, and that's each. So if there's a married couple, then it's $650,000. So these are big estates, but with property prices having increased as much as they have, many people fall into that bracket now simply because of the value of their property. So spend it. Take it from me. Go and spend it. Enjoy life. But if you can't spend it all, or you don't want to, because you're probably not going to change your lifestyle that much in retirement, unless you sort of develop a penchant for Ferraris or Rolls Royces or something like that, or round the world cruises, maybe you can get more pleasure by reducing your estate by giving money away. Now this is the best idea of all, really. Now, just a couple of things to remember. I mentioned in episode 67 the 7-year rule, which means that if you give money away now, you have to survive for 7 years in order for that to be fully outside of your estate. If you die within 7 years, the Inland Revenue will count that gift back in your estate when they come to calculate your inheritance tax after your death. So the 7-year rule is worth remembering. Another important thing to bear in mind is that you can't give something away and yet still retain a benefit from it. So you can't, for example, sign your house over to your children but continue to live in it. Or you can, but that doesn't work for inheritance tax purposes. The revenue will just deem that you never gave the house away at all, effectively. And I mentioned also in episode 67 about exemptions, being able to give money away in small bits. So the £3,000 exemption that everybody gets every year. So you can give £3,000 away, that's £3,000 per donor. I can give £3,000 away in each year. And so can my wife, and everybody gets that exemption. There's also the sort of special exemptions for weddings and things like that. And remember the little exemption, as many gifts of £250 as you want. The gifts from income, though, is the key exemption. I'm going to go over that next time in a bit more detail. But giving money away is a great strategy for reducing your inheritance tax bill. It just needs to be done carefully because you don't want to give too much away, and that's where financial planning comes in. And I'm probably going to cover that after I've finished off this section on taxation, this little mini series here. A few people coming along the beach with their dogs, so I'm going to wrap this up. The third way you can reduce your inheritance tax problem, well, it's not really reducing it. You can insure your liability. So you can work out how much tax you're going to pay and then take out a life assurance to cover that amount of tax. Needless to say, the life assurance policy mustn't pay out into your estate, else you've just made the problem worse, but it can pay out into a trust, which can then be used to pay the inheritance tax. So spend all your money, give it away, or insure the liabilities. These are the best ways, and really the main 3 ways you can reduce your inheritance tax problems. So I'm going to go back next time and look at number 2 in more detail. That's giving the money away. Maybe the one after that, a little bit more about insuring the liability, just to round off this section. So thanks very much for watching. From Long Rock Beach in the shadow of St Michael's Mount, thanks for watching, and I'll see you next time.